Well, many thanks for staying with us. And in case you're joining us right now, you're just in time for the big conversation surrounding or about the government-to-government oil deal and whether it is indeed a relief for the common man and for the country or a rip-off. And of course, this comes on the backdrop of ongoing investigations in regards to the importation of fuel with Energy Principal Secretary, that is Mohamed Liban, EPRA CEO, that is Daniel Kipto Bargoria, and Kenya Pipeline Managing Director, Joe Sang, all arrested, resigning even as the investigations continue. And today they appeared before the Directorate of Criminal Investigations for further questioning. Now, this comes amid the pressure which is mounting on Energy CS Opiyo Wandayi and his trade counterpart Lee Kinyanjui on them resigning, with CS Opiyo Wandayi today maintaining that he was not aware of whatever was happening in regards to the importation of that fuel. Now, here to make sense of the government-to-government deal, oil deal rather, and whatever is happening or has happened in the past 3 or so days here in the country, and what next for Kenyans, even as the war between Iran, US, and Israel escalates, with the Strait of Hormuz still closed despite threats and calls from US President Donald Trump for Iran, of course, for that particular strait to be opened, is one professor. Let me begin with to my immediate right, and that is Mr. Martin Achomba, who is a petroleum and energy expert. A very good evening to you, sir. Many thanks for making time to be with us.
Thank you.
Always welcome. Now, next, or in between the two gentlemen, is CPA Professor Elizabeth Kalinda, who is the chairperson of ISPAC. A very good evening to you.
Thank you. Good evening.
Many thanks for, of course, joining us this evening. Now, last but not least is Mr. Patrick Muinde, who is an economist. A very good evening to you, sir.
Good evening. Thank you. I'm glad to be here.
Let me begin with you. With me here is a copy of the Standard, not tomorrow's edition, but today's edition. And on the front page, we had the CS for Energy, one Opiyo Wandayi. And of course, the headline was, of course, he knew. The CS maintains he was not aware of the importation of, the saga surrounding the importation of fuel. And this is despite, evidence in terms of letters that were also written to him in regards to the entire process. There was a clear flow of information. So as an economist from your end, I don't know how you perceive all this saga as it unfolds.
Thank you. And I think it probably from the time the G2G started, we expected somewhere down the line this might happen. Because when you look at the history of all G2G that we have done, across different sectors, we tend to have scandals down the line because G2G programs bypass the competitive procurement process. And the history of this country is that most of the public procurement programs, especially the big ones, the large ones, that we cannot allow the competitive process, they narrow down eventually to G2G. We have seen that around the election cycles. We have seen that with fertilizer subsidies. We have seen that with means sometimes through imports. So I think it was all along going to happen because there's been a lot of controversy. There's been a lot of secrecy around what exactly we signed for G2G. And I think what you've seen now is evidence that probably the people who have been questioning about the transparency and accountability of the program have been validated. But I think looking at it from a policy perspective, such an import cannot happen without the policy driver being aware. I think it will not be right for the head of Ministry of Energy to say they were not aware. I don't imagine that in the environment that we are in, because we're in the middle of oil crisis globally because of the war in Iran and the transit, and all countries are trying to get ways of cautioning their consumers. So it would be very unfortunate if somebody who is head of policy in such a sensitive sector at such a sensitive time would not have been aware of what was happening around the country. And I think now we are being told that either data was manipulated to create certain impressions or certain perspectives to allow this deal to come in. But also looking at the season we are in towards our election cycles, we have had an history around every election cycle, either before the elections or after the elections, to have scandals around high consumer movable goods. And I think oil is part of that. We have seen all that trends. So we have seen edible oils either after election or before elections. We have seen maize, we have seen fertilizer. So around elections, either before or after, we tend to have such scandals. So I think it's quite unfortunate, and there's no way such an event will have happened without the policy head being aware. So it was always a question of when, not whether.
Fair enough. CPA, let me come to you. He has alluded to the issue of accountability. And the CS for Energy here, just briefly, says, he was not aware. And that is despite, that is the reason as to why I have this particular copy here, because we have, we've seen letters that were, if not written to him, they were copied to him, written by the PS for Energy, Mohammed Liban, who, was forced to resign or resigned, even as investigations continue. But the continued utterances by the CS that he is not aware, he was not aware, despite all these letters. What does it say about, the caliber of leaders that we have as a country, and when it comes to accountability, more specifically?
Okay, thank you so much for having me in this session. And considering I'm the chairman of the Institute of Certified Public Accountants, and this is the institute that is mandated by the Accountant Act to actually look at the financial management issues. Now, looking at what has been happening, the blame game, and everybody just saying this is not, I was not responsible, I'm seeing it as a systemic failure. And this is a failure that relates to the public finance management, because ordinarily, looking at the PFM Act, any person who holds an office and a public office, this person is supposed to have the interest of the country. He's supposed to ensure that the finances and the funds of the country are used for purposes that they're intended. So the discussion over whether I was aware or not, the papers that are moving around and the documents showing, I think for us, that should not be what we are actually arguing about. It should be who had that responsibility. And the CS, definitely, he should have been on top, especially on matters relating to emergency fuel requisitions, because that is not something that the three senior people and the other two who have gone home really could have made those decisions on their own. So for me, I take it as a systemic failure that touches on quite a number of things that actually have surrounded the G2G procurement that the government undertook. And looking again as coming from the accountant field, and also looking at what the Auditor General has been saying, there's a lot of, there are so many issues around this G2G that are quite opaque. We don't know even policies are surrounding how certain things should be done. We don't even have a policy in relation to how emergency procurements should be done. So there's a lot that meets the eye. And we need to really go back and see exactly how are the policies implemented. Are there gaps within the policies? And every person who is responsible should actually be taken to account. Yeah.
Fair enough. Mr. Martin, let me come to you. As a petroleum and energy specialist, there's one other thing that has raised eyebrows. The fact that the alternative, this oil that was imported, because the Strait of Hormuz is closed, so meaning we had to find an alternative. But this was so swift, and according to the reports that we have, is that this vessel was headed for Angola. But it seems like it was just standing somewhere nearby, waiting for an opportunity. And that opportunity came. Do you see a red flag somewhere within?
So thank you. Thank you very much for having me. I chair an organization that represents the petroleum outlets within the country. And so I famously tell people that I look at things from the worm's eye view. And from worm's eye view, the trade of petroleum in the international arena at times is akin to the way sometimes you would wish to order for a lorry of sand. You realize there are people who have those lorries waiting in the nearby places. In the high seas, there are people who hedge, who just wait there with the petroleum. And so it happens that the minute you need, if you remember, there's a time we needed some maize from Mexico. And from between the time that maize was ordered and the time it arrived, Mexico became very near. So that tells you that it was somewhere. Having said that, there's something that I've realized that I think there's a silver lining to everything. And first of all, is to appreciate the speed with which we can handle and tackle corruption if we need it. If what has happened is anything to go by, it points to the wherewithal of the government of the day to tackle any type of corruption with that kind of a speed, because it must be commended, the action, the speed with which that action was taken. So when we come back to whether there's a substantive issue in the now saga, I would wish to say two things. One, G2G cured a problem that we had when it was instituted. One problem we had is that we require about 460 million liters of petroleum in the country every month. And that calls for about $500 million every month. And before G2G, we were scampering for those dollars every morning. And so we were putting a lot of strain on the shilling, and it was losing against the dollar. So to that effect, because we give credit where credit is due, to that effect, we were able to stabilize the dollar. But it also comes with some of these complexities. I argue, I'm not an economist, but this is my argument, that economies react to realities way faster than they react to arrangements.
Okay.
That is my street economist. What do I mean? When there's an alleged, or rather when we can see in our media spaces that there's geopolitical tension in the Middle East and the Strait of Hormuz is about to be invaded, the market reacts immediately. When President Trump tweets or writes on the Truth Social and says that he's going to bomb Iran, we've seen between yesterday and today, the barrel go from about 110 to 120, just because of that. Other arrangements notwithstanding. And so, as we speak, we have seen in US, which is a major oil producer, hike the prices by 25%. We have seen Tanzania, our neighbor, do 30%, I think 33% just the other day. We've seen Europe do about 20%. China and Japan doing about 11%. Okay. All those are producers of petroleum. Kenya, we are not. We have not raised our prices. What does that tell you? That our economy, there's something that is artificial about the movement of this oil, because the reality is the prices have spiked.
Okay, fair enough. Let me come to you from an economist point of view. The president came out and said the government-to-government oil deal will cushion Kenyans from the immediate shocks of whatever is happening, and even, as he puts it, the rise in the cost of fuel. But the question is, for how long? Because as we speak today, and he has alluded to it correctly, I think a barrel now goes for around $120. For how long will the government-to-government deal cushion Kenyans, if at all it will? Because there are talks about probably from next week, because we are awaiting the prices review from April next week. So what should we expect? The prices will remain the same, or will there be an increase?
I don't believe the G2G anticipated or factored shocks like what we have. So the kind of price stability that we are seeing right now is because of government subsidies that they are proposing, especially because of the regulations. Because when you look at what is happening, not only in Kenya, some countries have reacted to target taxes on petrol so that they can maintain the prices low. We have not touched the taxes yet, but I think the government had proposed subsidies. Subsidies means that you need to take either money from somewhere else to cushion the dealers and the marketers, because the G2G is still a commercial transaction. And being a commercial transaction, it has to react to forces of demand and supply. And it has to respond to disruptions. So the challenge is that if that contract was not allowed or did not factor such flexibility, it means that the government will have to find an alternative. And probably that's why you could see this emergency import. Because if, for example, the company that we had signed agreement with them, they cannot supply the oil because of the external factors, because this is an external factor. They can argue within their commercial contract that these factors could not have been anticipated. So what that means is that at the end of the day, we'll have to adjust to the forces of demand and supply. We'll have to adjust to the global price increases. They have to be reflected somewhere, because this framework had a proposed pricing. Now, if that pricing has to be maintained, the commercial suppliers have to know or have to get a way of being compensated. So if you look at what is being proposed for Kenya, Kenya has been countries that have been considered to have maintained their price this month because of regulation. Regulation means that the government puts controls so that if you are a oil marketer, you cannot adjust the price based on the demand and supply. Now, G2G is within the economic system is normally an interference with the market forces, because the deal market structure is that it adjusts based on prices of demand and supply. So when you bring this framework, it's a distortion to that force of demand and supply. So the market cannot discover the prices. So it means that you have to fix the prices. So what we're experiencing right now is because of the government fixing or intervening. But these governments have to compensate the marketers, because nobody is going to sell their fuel at a loss. Nobody in commercial transaction can accept a loss to cushion consumers. So we do not expect the prices to remain. Either the government will have to focus on what other countries are doing. Many countries have responded. Some have eliminated certain taxes. Some have removed certain levies. So the government will need to figure out either they put the money to compensate the oil marketers and also the suppliers from the G2G arrangement, or they'll have to allow prices to go up so that they can factor for the changes in the global environment. So I don't think that the prices are going to remain as they are.
Now, before I engage CPA, again, as an economist, we've seen and heard calls from various leaders, especially in the opposition, of course, Rigathi Gachagua and even the former chairperson of the Budget Committee, Ndindi Nyoro, talk about, the government having to put measures in place, and that includes making fuel VAT exempt. How is that going to help?
That would be a form of a subsidy, and that will be the most effective. Because you remember before 2022, we were running a subsidy program where the government was compensating the oil marketers directly. But that brought a problem that between the time the petrol or diesel is sold at the pump, the government does not compensate you immediately. So you have government holding billions of working capital of oil marketers, and they are strained for working capital because they need supplies. They need to keep their pumps running, but the government is holding billions for them. And I think the G2G was trying to avoid that scenario where the government is compensating them directly. But when you look at what other countries are doing, and the most efficient form of subsidy is to remove the tax so that you don't collect the tax from the consumer. And because like VAT is a direct price to the consumer. So the moment you remove it from the petrol products, it means that the consumers are getting relief immediately. And then you do not interfere with the working capital of the oil marketers. Because by design, governments are not efficient. So they cannot compensate oil marketers as efficiently as they ought to do. Yet people in commercial business, and I think what our expert is saying, they move millions of liters every month. And the government cannot match that kind of revenue. We also need to look at the environment, the fiscal space that we are having. Government is struggling with liquidity. We are seeing delays in disbursement to counties and other agencies. So if they are to look for these billions, it will be a serious strain on the economy. Okay. So the best way is not to collect the money at the pump price. And you either target there's the fuel levy, there's the VAT, and you look at the pricing, the pump price in Kenya. And I think the biggest criticism for the G2G is that when you look at the other countries in the region, we are still the highest. The pump prices are the highest in Kenya, sometimes not because of the cost of the supplies, but because of the taxes. So if we are going to give relief to consumers, we need to target the taxes. And there's nothing wrong with government waiving certain taxes to avoid or to cushion consumers, because that's the most rational thing to do right now, and the most efficient one for that matter.
Fair enough. Prof, let me come to you. From an accounting perspective, this, from your understanding, and from what you've gathered in this government-to-government oil deal, does it have a price capping mechanism to protect Kenyans from, for example, this global oil spike, or are we still vulnerable as we were under the open tender system?
Okay, yeah, thank you for that question. Now, maybe a question that you had asked CPA Momo is, you had asked about how are we expecting the oil prices to be now in the market. And one of the things that we need to know is that when it comes to the pricing of the fuel, the biggest percentage, around 55 to 60, comes from the landed cost. And that is the actual cost at which we've bought the fuel. So if the prices go up, then definitely the price that we are paying at the pumps is going to go high. So, and looking at the G2G arrangement, we don't have a price that is fixed, as my colleague has said, because if it was an open tender system, every time a delivery is done, it is going to be based on the price at that point, let me say the spot price of the fuel. But now with the G2G that we have, it is the prices have somehow been fixed in a way, and we cannot actually retract. So we still have to pay the higher prices as much as the prices will go down. And that is why the president said that this arrangement has in a way cushioned the government, the country, because the prices have been fixed. Now, again, looking at our oil prices, currently you'll find that around 40% is the taxes. And these are different types of taxes. So for us to be able to just ensure that the fuel is affordable to Mwananchi, then we have to look at those two items, especially the taxes, because they are quite high. And Kenya, even compared to other countries, we find that Kenya, the oil is very, very high. Now, back to the G2G arrangement. Now, looking at this arrangement, it is quite unfortunate because its initial intention was actually to sort out a dollar issue. And this was to be for a short period of time. But looking at how the contract had been stated in terms of what we are promising as a country are quantities or volumes that we need to buy. So, and when Uganda pulled out of this arrangement, just after a few months, then we had to absorb those extra quantities of fuel that is coming to Kenya. And looking at Uganda, they have actually got another route. So the oil that Kenya was, the oil marketing companies were selling to our neighboring countries, that market is now out because they have an alternative fuel that is cheaper. So looking at this deal, there are certain things that need to be actually put in the open, because up to now, Mwananchi and almost everyone is not so sure about how it was stated, and the terms that maybe are quite unfavorable to the country are not, are not at our side, so we cannot be able to know. But the bottom line is that we didn't expect the Iran war with the US to happen. And Kenya now finds itself in a situation where we have that concentration risk. Looking at our oil, it's just coming from one region, that is the Gulf area. So we are going to be very exposed. We cannot come out of this contract. We still have to wait until, I think, 2027, 28. Yeah, so we are still stuck on this, and we have to bear that brunt of the high fuel prices. Yeah.
Fair enough. Of course, there were concerns about the secrecy, and
sure.
This contract was never made public. Coming to you, there are various concerns, and one of the concerns as well is that as a country we did put all our eggs in one basket. The president talks about diversification. How big of a risk was us just depending on one region? Because I know CPA professors talked about it not being really a good deal, but some argue that it was a financial masterstroke, but geographically speaking, we're being held hostage now.
Yeah, thank you. My thoughts around that is that we enjoy fuel basically at the benevolence of peace at the Strait of Hormuz. In the absence of that peace, then we are susceptible to every shock that comes with that. And we usually say that in social science that hope is not a strategy, hope is not a plan. We cannot anchor our access to petroleum in the country on hope that there will always be peace at the Middle East. And so the question of diversifying the sources of this fuel comes in handy. Today, Strait of Hormuz controls about 20% of the world oil, meaning 80% of the rest of the world oil is still accessible. But all of our oil, if you look at the geography of the Strait of Hormuz, you realize all the countries that we get our product from, the strait we talk about lies in between Iran on one side and the Gulf countries, that is, we get fuel from, that is Abu Dhabi, Saudi Arabia, and Dubai. So all of our eggs are in the same basket. So today, given what President Trump is talking about, if the things were to go very bad, such that we are not able to get product from that side, it would become a disaster. I know the providers of G2G have not declared force majeure. And so maybe in one way or the other, they are still struggling to get us product. But in the long term, that is not a plan. In Kenya, we also lack something that the Petroleum Act of 2019 envisaged. That is strategic oil reserves. Because if we had strategic oil reserves, we would be cushioned against some of these shocks and at least last at least 90 days. They had envisaged 90 days for fuel stock. Today, if we have no vessel landing at the port of Mombasa, we don't have stocks that can last us beyond a month. And that is extremely dangerous. And one of the things that is bringing a lot of issue with that vessel that has docked is because of what they call the vessel scheduling committee. There's a way those vessels are scheduled to arrive at the port. And so if a vessel is late, and there is a supply gap created, then we find ourselves in a very hard situation and we can easily go dry. And so these vessels have to come in a systematic, orderly manner without failure. So in case of these kind of shocks out there, we cannot last beyond a month. And so the country has an obligation beyond the arrangement of G2G and the open tender system. Actually, G2G is an appendix of open tender system. Beyond that, we need to get to ourselves to operationalize the oil strategic reserves.
One would ask, how flexible are we to pivot back to probably the open tender system if the situation gets worse?
We can easily pivot back to open tender system, because the beauty of open tender system is that all the oil marketers sit at a table and we just give them specifications of the qualities of oil that we need. And so everyone, the professor here says, I can get this fuel at this price. That one says at this price. It's the reason why it's called open tender system. And the one who has the best and has the capacity, we give them the tender to bring in the fuel. But that can only happen now if our partners in the G2G declares force majeure. And up until that time, it might not be coming.
Fair enough. Coming back to you as an economist, if the war in Iran continues to weaken, the shilling, because that is what has been anticipated, because as at last week, the Kenyan shilling was almost hitting the 130 mark. The last time we were at that mark was in 2024. So my question would be, how much more will the taxpayer end up paying in exchange for the rate losses?
Any distortions in the forex market will have to be reflected in the consumers. And unfortunately, it doesn't matter where you are within the sector of the economy. Any distortions within the energy affect everyone across board. For example, if you're a farmer in a village, you need supplies to be delivered to where you are. If you are producing anything from your farm, you need to get to the market. It will need a transport system. So energy is one of the most disruptive factor within the inflation matrix, because it affects everyone. So, and I think this was one of probably the issues that were discussed in the G2G, was to deal with the dollar problem. And there was an impression that was being created that would be paying for oil in Kenya shillings. I think that was not purely factual. It was just a question of delaying when the exchange will happen. And I think that's what Choba is trying to explain, that we were just trying to manage when the impact of the dollar will be, to allow a bit of stability. But eventually, as the market is being distorted, because unfortunately we are an economy where dollars, we are competing for dollars for everything. We are importing toothpick, and importers of toothpick are competing for dollars with oil marketers to import oil. So this is the unfortunate situation where we are as an economy. So any distortion with high movable products like the oil, it is going to definitely distort the forex market. And once the forex market is disrupted, we expect the impact to be instant and immediate across all sectors of the economy. So I think for consumers, it's probably will still have to share the war, because the shocks from the war will have to be shared across different countries. And I think only countries that had strategic reserves, and I think I've seen countries like New Zealand, which had enough strategic reserves, are the ones that are able to tap into those reserves. And unfortunately, and as Chomba is explaining, we do not have such a privilege. We do not have such strategic reserve that can buy us time. And I think the G2G, as long as the disruptions continue, might have to be relooked at because of the risk implications. Because the moment the suppliers cannot supply, they will need to get away out of the commitment and agreement.
Okay.
And I think we have seen some companies already declare the force majeure risks, where they say we cannot continue to supply because of these external factors. So I think it's a question of when, not whether.
Just in 1 minute, kindly, when you talk about, this impact, and even on the Kenyan share, for a farmer in Nyandarua, for a farmer in Trans Nzoia County, for a trader somewhere in Kakamega, what will that mean for them in the coming months?
Specifically to mean high cost of supplies, if you are dealing with the supplies like inputs in your farm, but it's also mean high cost to move your products from wherever they are to the market. Because either way, you require a transport system that relies on the oil. So I think it's an impact that will be shared across board. Even for people who are in urban areas, you need to go to your workplaces, and if the oil goes up, the matatu operators will have to adjust their prices. So everybody is going to share in the cost, unless the government now intervenes and takes the shock through subsidies. And I think we are seeing other countries provide. The government takes the shocks at the tax level so that you maintain the price at the pump price stable. It's a question of how far the government can let it go out, because it's going to have a ripple effect, especially on other macroeconomic factors.
Okay, let me come to you, Prof. And again, in regards to this government-to-government oil deal, the government is somewhat, window dressing on what, because I was going through it, and they say the government is somewhat window dressing of forex reserves by pushing oil payments into the future. As an accountant, do you probably see this as a sustainable fiscal strategy?
Yeah, definitely. That strategy works in a way, because currently looking at how the G2G is structured, there's an extended period of payment from the open tender from 30 days to 180 days. So what this means is that when the fuel is sold, the buyers in the market actually pay using the Kenyan shillings. And this is for a period of up to 6 months when the payment will be done. So in a way, this definitely cushions the demand and the rush, maybe, or even the speculative attack on the Kenya, on the dollars. So in a way, the strategy works, and that is why initially I had said when we started this G2G, the initial intention was to cushion the fluctuations in the dollars, so that as the payment before, the payments were done by were done using the dollars, but now they are put in the extra account in Kenya shillings, and then within the period of 6 months, the banks, the 5 banks that have been given that role, are able now to look for the dollars without putting a lot of pressure on the central bank on the reserves. So in a way, that actually was working, and that's why I was saying, looking at this strategy, yes, it is a strategy that worked at that time as an emergency matter, but then now it has gone beyond. the period that it was supposed to serve. And that's when now we are getting into this problem. Because previously when the fuel prices went down, Kenya could not enjoy that. And that is why Uganda had to opt out. And currently it is buying fuel at a much, much lower price. So looking at it from an accountant point of view, it will be important that some of the issues that even the National Treasury had recommended that we have a multi-agency task force to look at this contract and look at this deal well, that should have been done before. But again, looking at where we are now, I've said that Kenya is not in a position to opt out of this deal unless it is going to pay the penalties around that, which is again going to cost a lot of money. And looking at the current situation where we have the war in Iran and the US, this is not the right time to opt out. So for me, the best thing that would be done would be, if possible, Kenya should actually engage into, we should have a portion of our oil coming from the G2G and another portion coming from the open tender system. Otherwise, we cannot bank that we are just getting our fuel from Gulf area and with what is currently happening. Yeah, so those are some of the policy issues that need to be done. And as I previously said, the Auditor General came up with very good recommendations and some of the gaps that were there. If these things had been checked by now, I believe that we'd be in a much, much, much better position as a country. Yeah.
From where you sit, what are the other viable options? Because even as we talk about, again, as we talked about putting our eggs in one basket, should we probably look at Latin America? Should we probably look at the Atlantic countries? Should we look at Nigeria? What are the other viable options from where you sit?
Yeah, the viable options, there are some that can be applied on a short term and others are long term. One of the key things that we need to do, we need to have strategic reserves and a policy around that so that we are having our own reserves in Kenya. And then another one, we have options on where we can get the fuel. It can come from even West Africa, which is an African country. We've seen quite a number of countries that are actually exploring that route. But this concentration risk of just having countries in the Gulf, maybe by then we had good relationships and we never expected what is happening to happen. So this is something that we need to do. And then another thing, we need to have a proportion of our oil, even if it's 40%, coming from the open tender system, so that we can be able to have the price, the spot price of the fuel. Otherwise, as it is now, the deal is almost locked, and we have to pay for those high prices. And that's now why, looking at the stock levels that are supposed to be held by the oil companies, you find that there's a disparity, and that's why we are saying there's manipulation of data in terms of what are the quantities, in terms of the days that we have. So we also need to have a mechanism that can be able to monitor how much oil can be held by the companies, how much of the fuel can also be held by the country. And looking at the way the country is at the moment, we find that those reserves, the number of days are too short, such that if there's an elongation of this war, then definitely we are going to be in serious problems. And just as it has been discussed, we note that fuel drives the whole economy. It doesn't just need to be fuel. So many other things, the production, so many other things. We are a net importer. Our currency is going to go down. So, the whole economy is going to be affected in different ways. Yeah.
Okay, coming back to you, there are concerns that under this G2G arrangement, we are paying more freight and premium costs. From where you sit, and that is, of course, compared to the open tender system. From where you sit, do you feel there are other hidden convenience fees that we're paying under this particular deal that we shouldn't probably be, paying?
Okay. Other than the what is provided for within the contract, the fixed premiums, I'm not privy to any other costs that is there. But what I know is these premiums were good to stabilize, like Prof has said. But unfortunately, when the global prices go down, we don't get to enjoy to that level. When the prices go up, the premiums may not go up, but the costs of the product goes up, and so we are not safe either, and there's that disparity. So at some point, what you'd call efficiency in providing product, it's a good market-based value within the global system, sometimes is not achieved. So what we achieve is stabilized price, but not the competitive price. So basically that's what the premiums provide us for now. But in any other way, we are very, very much exposed to these other costs.
Now, one other issue that has been raised time and time again about this government-to-government deal is that it benefits Kenya's political elite. I don't know whether you hold the same view in regards to that.
So let me give you an angle. You see, out of the 6,200 petrol stations we have in this country, 68% of that number, petroleum outlets are non-franchised, what you call the independent petroleum dealer. These people, because of the nature on how they start their business, because they are not you and I who sit down and come up with a business plan to start that business. They basically start the way a mama mboga does their kiosk. Somebody is looking for something to do, and you'll notice that the village you come from, the village I come from, the village you come from, there's somebody who sells fuel there. At this time, we have had a lot of issues in some places, especially in Mount Kenya, where there are stockouts of the majors. The reason being, and I've explained this time and again, is that these people do not have product. The reason why they don't have product is because they don't have the leverage of capital. They don't have the leverage to organize themselves in a way that they are able to participate in the importation. So what basically they do for them to get this product is scavenge. And they scavenge from those who are able to import this product. So when something like this happens, I always like to remind people that the government of Kenya does not own even 1 liter of oil. All the petroleum in the country is in the hands of private sector. The private sector is answerable to the shareholders. The CEO of a private sector company is answerable to the shareholders. And so they look out for their shareholders. So in as much as we don't fault them, the way this importation is done, the way the pricing of the fuel is done, is that the vessels that came in between 9th of March and 10th of this month will be weighted on average and will be given the price. And so, in as much as the price has not come out, they already know what is happening. And so, they are not able to sell at the price that was given previously, because they know at the end of the day, they'll have to go back to their pocket so that they can buy some more. So what is happening is, because of that, this group of 68%, they move a throughput of about 40 to 45% of all the product that is moved in this country. They are now, most of them, going dry. And the effect of them going dry is that, like for me, where I come from a village called Kangaita in Kirinyaga. And the town where you find a major is in Kerugoya town. So if all these villages where I come from do not have product, we have approximately 2,000 motorbikes plying the Kirinyaga area. These motorbikes, logistically, cannot be fueled by a petrol station, the ones we call majors.
Okay.
So that's how now you end up finding these stories of stockouts. And so what we have been saying is that it is in the interest of the oil majors, it is the interest of the government to bring up a policy that makes sure that these people have fuel. Because in as much as they don't leverage importation, they are a critical component of the real economy.
Okay.
And without that product, then we are creating a psychological shortage. We could have the molecule, we could have even the product in the country, but as long as it cannot be accessed by those people in the village, that psychological shortage will be there, and it is going to trigger panic buying. And once the panic buying is triggered, it doesn't matter how much stocks we have, we'll end up having a crisis.
Okay, we're almost running out of time, but coming back to you from an economic standpoint, there's the issue of the stabilization fund. Because the government is, according to reports, thinking of deploying that particular fund. How, in terms of impact, how swift will it be to alienate Kenyans from the effects of the global spike in oil prices?
Maybe based on earlier experiences, and I said you look at the subsidy, because it can only be done as a subsidy program. We look at the experience we had in the season before 2022, when the government was implementing the subsidy program. it was causing a lot of distortion in terms of oil marketers and government compensation or refund or reimbursement. And I'm not sure whether we have enough capital to run that program. And I say the most efficient subsidy system is where you don't collect the tax. Because if you don't collect the tax, you don't have intermediaries. Why collect the tax, take it to KRA, and then start returning back to the very marketers and dealers who are dealing with the oil? So why don't you take it from the tax so that you don't collect it from the consumer? That is the most effective, and that will be the most efficient one. Because the moment you start collecting the money and then you start returning it back, we know this country, we expose ourselves to another problem, what we are seeing, corruption. And probably to also chip on the question that you're asking, that G2G was to benefit the political elites. I think when you look at the history of this country, anytime we are going to G2G, we are trying to bypass something. And that something is the most efficient, the market forces. You can look at another sector, for example, when you look at the telecommunication sector. If you go back to 1996, 1997, when telecom controlled the sector, today, 3 decades later, we are calling at a lower rate than it was that time. What caused this price efficiency? It's competition. When you allowed and opened the sector for competition, you allowed the Safaricom's, the Airtels, and whoever wanted to get into the field, the market forces brought the efficiency, the innovation, and all that. Now, G2G and government regulations distort the forces of the market.
Okay.
So it's always an interference. And in this country, I think the government is strongly one thing that we call legitimate, trust from the citizens. And from a past experience, we have not seen deals that are not transactional. And I think the main question here we're asking is, from a macroeconomic perspective, we need to start looking at the country in the long term and from a strategic point of view. If we are looking at the country from a long-term and strategic point of view, we'll be able to make the right decisions. But these are transactional arrangements that benefit the elites.
Okay, just to be fair to Prof, as you give me a final remark because we're running out of time, does this particular G2G, briefly, does this G2G deal, distract us as a country from, being energy independent, from exploring other, avenues, options?
Probably as a country we became a bit too comfortable with the deal, and looking at the initial intention of having that G2G arrangement, and that's why we keep having extensions on it. It should have ended. So indeed, it actually prevents us from having the real spot prices for fuel, and also from our strategic reserves. I think when we entered into this deal, in a way we just forgot, and we did not go to look at what would happen in case there's an emergency. But then I also wanted to just add on the stabilization fund. And
briefly.
Yeah. Now, remember I said about the escrow account where the dealers deposit the money in Kenya shillings, and then we earn a 10% interest. So this interest is the one that is actually supposed to stabilize the prices. But as it is now, the policy or the framework around how that stabilization fund is going to be used is not clear, and that's why we are not so sure whether that fund goes to the to benefit the wananchi at the pump prices, or it goes to the oil dealers. But maybe just as I wrap up, from an ISPAC perspective, what I'm saying is this: for corruption to be out of the country, for integrity to happen, we need to have a change in the tone at the top, so that every person who is in this chain, whatever they write in their books, whatever they, for us, we are the accountants who do the mathematics, and those of us who actually check on the integrity of the work. When we have that integrity starting from the top, I think the whole process, otherwise having laws, having all these cases will not sort anything out. Yeah.
Seems like we have a long way to go. In just under a minute, kindly,
Okay.
From a specialist point of view, what next for the government?
What next for the government is basically to take a haircut. I'll give you an example. When 2020, we had the COVID, everybody gave a concession. The government, and the people. So it is in the interest of the government to be seen by the people giving a concession, and most likely by giving up some of the taxes, so that also people, when the prices also go up, people feel that we are in this together. If we leave it to the common mwananchi to absorb the shock, then it will give an illusion that the people are on their own and the government is not part and parcel of it. So it is for the government and the people to take a haircut together so that we can feel we are walking in this journey together, because it's going to be a treacherous one.
Fair enough. Ladies and gentlemen, many thanks for, of course, joining us this particular evening to help us understand the dynamics surrounding the government-to-government deal. That was a conversation here on KTN Prime. Many thanks for, of course, making time. Until next time, do have yourself a wonderful night, and like always, God bless.